All right. Every single one of you, all right, listen. Every single one of you never ask how I'm doing. It's always, how are mortgage rates doing? And I get it. They affect your paycheck a little bit more than I do. So it makes sense. So let's take a look. If you guys have ever heard me talk about mortgage rates, the number one killer of interest rates is inflation. Inflation is the driver that either drives them down or up. And it's simple to think about because when inflation goes up, what do the feds do? They raise their Fed's fund rate to bring money out of the market and into the Federal Reserve. So therefore, there's less money in circulation. If there's less money in circulation, then inflation is going to go down, right? Well, kind of. But that's what the feds always think. So what makes people bring their money in out of the marketplace? Well, if we raise the Fed's funds rate, that means a 10-year Treasury bond from the U.S. Treasury is worth more than it was before they raised rates. And if you know anything about a 10-year Treasury is that it's a guaranteed rate of return backed by the full faith of the U.S. government. But if that is a guaranteed return, we know mortgages are always a safe bet. Well, not always, but typically a safe bet. Very low amount of risk, but there's still a little bit of risk associated. So easy math. Let's just say that the 10-year Treasury is at, I don't know, what is it at today? 4.27. So let's just say 4.25, and that's the rate of return you're going to get. Well, if I had a bunch of mortgage-backed securities and I wanted somebody to invest in those, I got to give them a little bit more of a yield. They need a little bit more of a return. Yes, it still is relatively low, but we need to give them a little bit more yield, a little bit more interest, if you will, to entice them to invest in mortgage bonds. So if a 4.25 is the 10-year Treasury, well, I'm probably going to have a 6.25 on mortgages just to get them to invest. Because, and if you think about it, every single pension, every single almost every retirement account on the face of the planet is built off mortgage bonds. So that's a lot of money, but we still have to entice them because if I'm going to give out 5% mortgages, but I could go over here and get 4.25 from on the 10-year Treasury from the US government, I'm going to go that route. So they need to raise the yield to entice people to invest with mortgage bonds. Therefore, when inflation goes up, the feds raise rates, the 10-year Treasury goes up. That means they have to raise mortgage rates to compensate. It's not that hard. It's not exactly the 100% foolproof science behind rates, but I'll tell you this, when the feds have lowered rates all of the past, 12 months, every time they have, mortgage rates have actually increased. So when the next time you hear a loan officer say, well, rates dropped, well, yeah, those are the Fed's funds rates. That's not mortgage rates. And that's why we're still seeing, because inflation right now with the war, and I'll be honest with you guys, we were having a great run. We were having a great run. And I'm sure you heard every loan officer coming to you saying, oh, rates are so low, rates are so low. And then you went on your social media and you posted it. And now you look like maybe you don't know what you're talking about. But that's okay, because now you do. So make sure that you guys listen to this. Reach out to any questions that you guys have or any of your clients, any questions that they have. I would love to speak with them. Right now we are seeing rates. They have increased quite a bit. No matter what you hear, they have increased quite a bit, especially after the Fed's meeting yesterday. That did not help at all when Jerome Powell got up there and started speaking at the end of it. So reach out with any questions. I'd love to quote some rates, but you guys might as well just think we're in the low to mid sixes where we were in the high fives just a couple weeks ago before the war. But again, everybody is afraid of inflation right now with the price of oil going up. Price of oil going up is inflationary because guess what? How does it all the goods that we consume, it gets to the consumer, to the store via oil. And if the price of that goes up, that means the price of the good goes up. That means the cost goes up to the consumer, goes up in turn. That's inflation. Then we have mortgage rates follow suit, which is why we have seen mortgage rates increase dramatically over the last 3 weeks.